Hi, I'm Tom Lydon, editor of ETF Trends here in San Diego at the Schwab Impact Conference. Here with Ed Coyne, who's Executive Vice President of Sprott Asset Management. Ed, great seeing you.
Thanks for having me, Tom.
So let's talk about alternative strategies that advisors need to think about as they're looking at 2017.
Sure. The big challenge that a lot of advisors have is how can I get some capital outside of the traditional stocks and bonds that I have my clients in? How can I find something that performs differently than my stocks and bonds? So what we focus on is the physical metal market. So we have some gold trust, some silver trust, and some platinum palladium trust. The gold trust is really a monetary asset, so people are looking really from a monetary standpoint. The silver trust is really monetary and industrial manufacturing asset. So as people start talking about that, the first step I go to before we get to the ETFs that we offer is our trust. And we have a physical gold trust as a way to get capital out of the market for a client that wants to own the physical metal itself. It's unencumbered, it's fully allocated, so the client physically owns it. They can take delivery of that metal, and it trades as a closed-end trust under the ticker symbol PHYS.
So it's got a bid-in-the-ask spread,
It's got a bid-in-the-ask spread.
It trades on the exchange?
Trades on the exchange,
okay,
yes. So that's a very simple way to do it, and
Great.
that really leads to the next conversation, which is, if I want to do more than just own the physical metal, how can I participate in the broader market? And we have a senior mining ETF, and we have a junior mining ETF. And what's unique about those is that they have a factor-based overlay to them. So they're not simply just constructing the ETF based off market cap, meaning the largest company isn't the biggest position in the portfolio.
Right.
What we're looking at is saying, okay, are these good companies? Are these good stocks over and above if they're a mining company? So do they have a strong balance sheet? What kind of debt do they have? Are they good stewards of capital? And then we rebalance the portfolio based off the strength of the company itself from a quality standpoint.
Great. So how might a client or an advisor right now, as you're looking at 2017, how would they incorporate that into the portfolio? I mean,
Sure.
and what, there are a lot of gold and mining ETFs out there.
Right.
How's the strategy a little bit different?
Sure. Well, the main difference is really the quality component, right? We have that factor overlay. So what you're finding is there's other ETFs out there right now that they're actually consolidating, or they're actually using the senior mining ETF in their junior mining ETF because there's not enough capacity there, right? So they're capacity constrained. And so a lot of capital is flowing in that area because there's an appetite for it. What we would say is, look, the best companies or the biggest companies aren't necessarily the best companies, right? There's a lot of things, they actually are eroding that mine as far as they're digging deeper, they're having to spend more money, they have to raise more capital, they're stressing their balance sheet to do so. So we would say, we look at what we do and we look at it at a factor-based standpoint. It's actually looking at the higher quality, better balance sheet type companies. So that's really the main difference with us relative to the standard indexes out there.
So if you like miners, and there are a lot of options out there, but there aren't a lot of smart beta miner options.
That's exactly right.
That's what you guys offer.
That's what we do. So if you want a smart beta approach to the mining space, then SGDM, which is our senior mining ETF, and SDGJ is our junior mining ETF. And simply put, I say senior, they're in production, junior, they're still in the discovery mode. That's a really simple way to think about it.
Excellent. Perfect. Thanks, Ed.
You're welcome.
Good
Thanks for your
seeing
time.
you.